Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is May 23rd, 2016 edition of Market Outlook. So definitely sloppy picture of the market, but overall holding up. Let's get into it right away. Also, don't forget to sign up for this video. You get it free every week and along with the commentary and text. So heading over to Little Big View, let's see what's going on in terms of volume and change. So overall, as you can see, the the price change for the year, things are basically flat to slightly down, although trouble in NASDAQ land, right? Down 4.8%. Again, not bad price action for the week. It was the first time we've been up over the last 3 weeks in a lot of these indices. So that was positive thanks to Friday's action. In terms of volume, can't really say that there's any significant volume pattern that institutions are accumulating or distributing at any particular pace, with the exception of the Russells. Even though they had the best reversal this week in terms of price action, let's see, the 1 week price action for the Russells was up over 1%, leading the 4 key indices. However, there's still pressure on it because you can see distribution, still 4 distribution days. So Russells and NASDAQ still under pressure. Diamonds or the Dow and the S&P picking up the lead, but sort of neutral here in terms of the read on volume and price action over the last couple of weeks. Really, even the downside action was, relatively muted. Let's take a look at the sectors and see what that's telling us, because a couple interesting things here. Well, for one, you can see the highlight here. Semiconductors moved to a bullish phase. Now, semis are generally considered more speculative, and that's good considering that there's a lot of cash on the sidelines. Maybe semiconductors is a early detection that more speculative money and more money will flow back into the market, but that's unclear. The thing that is persistent is utilities still continue to be the leading sector over the last 6 months and certainly year to date. So, you're pretty mixed. Half your sectors are up, half are down. What is interesting, and we'll get into that in a moment, is that sugar, right, has come alive over the last 3 months, up 33%, along with gold, silver, but more importantly, the gold miners. Look at this change in the gold miners, up 78% over the last 3 months, 27.5%. And that's with sort of a modest sell-off over the last couple days in these commodities and metals as the prospect of a potential rate hike hit the market. So it's pretty clear, right? 6-month leaders, the biggest gainers, gold miners, gold, silver, metal, and mining. That's where the money's flowing. Obviously, inflationary pressures picking up here. So that's what you have. In terms of on the downside, solar seems to be hit even as energy recovers. So that is interesting. And again, over the last 6 months, definitely a lagger here, down over 20%. So that's your overall picture in the market, right? Let's take a look at the market internals. and see what's happening here. Well, first of all, we're going to take a look at the S&P 500, and here we're sitting just right under our 50-day moving average. Okay? We tried to get through it on Friday. We were well under it for a number of days. So you got a confirmed warning phase with this downside trend here, or the slope of the 50-day. Now let's take a look at the up-down volume. What's interesting is we got a little wrung out at the beginning of the month, and that was a bit oversold. You had a bit of a rally, and we're basically back to where we started the month, give or take 0.5% or so. But more interestingly, the downside volume, or the ratio of up-down volume, definitely got wrung out a bit, hit the first part of oversold, has recovered, and now we're actually getting above this midpoint here. And if we can get above the action going back about a week or two, that would be really positive. In terms of the McClellan oscillator, early this week, we got oversold, right? We hit this bottom level. We got to oversold. What I'd like to see as a confirmation is a move back over the midpoint or the zero level. And that would definitely get me interested in a potential more sustained rally like what we had from here, right off the lows. Look at this. Off the lows back in February on the McClellan, we basically touched down, got above that midpoint or the zero level, and really took off from there. Similar pattern that occurred in the early part of April. You got a decent sized rally, and you really couldn't get overbought, which in itself was an interesting indication. And then when we hit and traded under that zero level, we got a substantial or a reasonable size sell-off. Now we got the inverse happening, but I really want to see this get above that zero level. In terms of advanced declines, again, we're sitting under the midpoint here. If we can get above here, that would be a really nice positive. Okay, so net in the S&P on internals, we're sort of in neutral to slightly positive readings. Looking at, let's go to the next chart. The composite. Interesting. Up-down volume actually crossed our midpoint here, 0.5, and that's a positive, right? We got sort of wrung out, crossed the that 0.5 level in up-down volume, got a bit of a sell-off, got a little bit oversold, rallied back up, but couldn't make any progress. And actually Friday's action, as we moved above the 50-day moving average, turned positive. Now, we also hit oversold on our McClellan oscillator, which is more intermediate in term in nature, and moved up, and we're yet to cross the that midpoint. But if we can get above there, that would portend a nice rally. Additionally, advanced declines wrung out, starting to move up. It looks like market internals after this 3-week sell-off a little bit more positive. Let's go to the next chart here. Okay, the S&P on new highs, new lows. What's interesting, as we've sold off here, we were really doing fine, running very nicely on new high, new lows, and look, we started now failing and rolling over. Not surprised with this action, but you know what? Friday's action actually, even with the up move, was not strong enough to reverse the trend. So that gives this a bit more of a negative, right? We got pretty rich above the 70% level, and then turned and has turned down from very, very overbought, which is the 85% high-low ratio, and now we're trading under it. So this rollover is definitely suspect. So let's take a look at the NASDAQ. And you can see the NASDAQ, in terms of new highs, new lows, making very little progress, right? We got running really rich, and as you can see, as we hit that 70 level, rolled over, we got the sell-off and more like sideways action. So it'll be interesting to see if we can get a hook back up here. That would be positive. But right now, NASDAQ, the weak link here, down almost 5% for the year, and you can see what's happening, right? The breadth of the market in terms of new highs, new lows, just not cutting it. So where the market internals, up-down volume, advanced declines, seems to be improving with that little hook up, this indicator here is still indicating more trouble. So net, much more of a mixed picture for NASDAQ, and this is telling the picture right here. In terms of market volatility, you can see this is our VIX indicator. Overall, we're trading in the middle of the Bollinger Band, under the 200-day moving average, just slightly above the declining 50. So it looks like to me on this one, you're mostly positive. This one is marginally, well, I would say more than marginally, mostly positive, with the exception of the fact that we're trading in terms of the volatility measurement above the 50-day moving average. But overall, again, with the 50-day moving average under the 200, that's a positive, because this works inversely. That's a positive for the reading in volatility by itself. So in the middle of the band, not touching or at any point in the excessive outer edge of the band with compression, that is telling you that players are relatively comfortable at these levels, and there's no excessive optimism or pessimism. So this is overall a positive for the market. In terms of another reading of sentiment, we like to take a look at 1 month versus 3 month volatility, and that's this chart here. And as you can see, we got running a bit rich. Anytime you get above the 1.2 level, that's running pretty rich. And then you want to see your trend lines or your moving averages turn down. The red is the actual absolute number on a daily basis, and the others are averages. So what we like to see is the shorter term average move through the longer term. That's where you are now. So volatility showing we got to overbought readings, moving averages moving down. You got a little bit of a hookup on Friday with the up move, but overall volatility is the sentiment. This is a sentiment indicator, and it's definitely showing a bit of negativity. So net, if you look at the overall picture, price action as we're sitting under the key moving averages, a bit more negative in terms of the S&P breadth. Looks to be improving. We really got to see a little bit more upside, and you could get a decent sized rally. On the other hand, NASDAQ still under pressure. Net market internals much more negative than the S&P. So big picture, pretty mixed. More sideways action, most likely to continue. And again, the issue is valuation. However, with employment doing as well as it is, even though it doesn't feel that way, or the press is telling you otherwise, overall, the unemployment levels, which are the most closely associated to the risk of recession, and that's where you get your biggest down moves, is not really a factor at this point in time. All right, that's it for now, and see you next week. Stay frosty and good trading.